Good morning, everyone, and welcome to Raskow's Market Update, brought to you by the Professional Development Committee. And I would like to thank our professional development chairs, Monique Olson and Ben Obliziak, who I will also introduce later as our president-elect, for coordinating this. And all of you probably know Mr. Lawrence Yun. He is presenting this morning. He's the chief economist and oversees the research group at the NAR. He supervises and is responsible for a wide range of research activities for the association, including NAR's existing home sales stats, affordability index, and home buyer and seller profile report. He regularly provides commentary on real estate market trends for its 1.4 million realtors. Dr. Yun creates NAR forecasts and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. He also participates in the Industrial Economics Discussion Group at the Joint Center for Housing Studies of Harvard University. He appears regularly on financial news outlets, is a frequent speaker at real estate conferences throughout the United States, and has testified before Congress. Dr. Yun has also appeared as a guest for C-SPAN's Washington Journal. Dr. Yun receives an undergraduate degree from Purdue and earned his PhD from the University of Maryland. Welcome, and take it away, Dr. Yun.
Thank you, President Melissa, and congratulations on your presidency, because at the local association, it's all important to represent the realtor's perspective in every arena, whether it is to the consumer or to the policymakers. So very big role. Thank you for inviting me to share some of my thoughts with you all related to this transitioning housing market condition. As we know, we look back, COVID, very ugly, disrupted our lives, but it caused a real estate boom in 2020 and in 2021. But just last year, 2022, this time, January 2022, things were still multiple offer situation. Then things began to soften somewhat by the second quarter. Multiple offers, not as intense, and you may even say welcoming, because you don't want to have a one winner and multiple loser situation constantly, having to start over the process again and again and again. So some coming down in the second quarter, but the third quarter became concerning, and the fourth quarter was quite ugly and painful because the transactions were simply not there. Because throughout 2022, what changed was mortgage rates going higher, further higher, higher, continuous, and it really choked up buyers. We are in the first weeks of January, the new year. What can we anticipate? The ugly conditions of the fourth quarter of last year? Or is there some hopeful signs that maybe things could soon turn for the better? Of course, our forecast outlook has filled with uncertainty, so many events going on, including today. I'm not sure if you can see it right behind me, is the US Capitol. We strategically purchased this land right at this location, built a building, to show Congress that 1.6 million realtor members are watching you, so that we want to be in close proximity, and certainly we relay our issue to the policymakers. They are our representatives. We voted. So the market condition this year, again, filled with uncertainty. Today, I think they're going to debate the debt ceiling condition with large deficit, large debt. How do we address this condition? So many uncertainty. All this, I speak better with PowerPoint slide. So let me put that onto the screen. So let me do that. So hold 1 second, please. Okay, so I think you are able to see it. And in case there is some disruptions, I'm sure someone will let me know. So this is overall home sales change that occurred in recent years. I put in 3 boxes. pre-COVID, essentially 2019 all the way up to March 2020. In hindsight, it was quite boring. Small changes, either small declines, small increases in home sales. Then we had the COVID real estate boom. Low interest rates, massive policy influence, interest rate of 3%, once in a lifetime opportunity. People took advantage of it. And then you had working from home situation where people said, I need a larger size home or get out of the big city, get out of Milwaukee, get out of Chicago, and maybe go closer to more mid-sized town like in Madison. So real estate boom during the early years of COVID. Of course, COVID is terrible, but at least regarding real estate, it caused a boom. But last year, as I alluded to, steady decline in sales activity as interest rate rose. If we look at annual figures, these are national numbers. The local numbers are very similar in terms of trend. And of course, you can go to the local MLS site or to the association website where they have more finer data points. But in essence, what it looked like is that we had the boom. So you look towards the end, the COVID real estate boom, but based on the numbers we're still tabulating for December across the country, the estimate is that overall sales activity will be down around 16% in 2022. And it almost matches the condition in 2014. 2014, we were just coming out of the foreclosure crisis. So this is quite a steep decline that occurred in 2022. In the meantime, prices have not declined. So when people are talking about housing market adjustment, housing market declines, or housing market tumbling down, it is referring to sales activity. It is referring to the business opportunity for people in the industry, realtors, home builders, mortgage brokers, but not for the homeowners. Your homeowners, your clients who purchase home with you in the past few years, they are quite happy. So there is no concern about any distress because homeowners are seeing this rising home prices. And furthermore, there is a very low level of mortgage default. They locked into those low interest rate and they're in quite a happy mood. Something to consider. Call them, say, how are you doing? Just because you want to associate their happiness with your service. So just a little reminder so that just in case they encounter some friend or business colleague who needs to buy a home, they can say, oh, I had a terrific experience with my realtors. I'm going to refer this client over to my realtors because homeowners are quite happy at the moment with very, very little distress. You can see this chart, which begins from year 2000. So home prices in the greater Madison region, several counties around the Madison. So back in the year 2000, believe it or not, median home price was $150,000. And you are looking back and say, darn it, I should have purchased 2 or 3 additional properties back then, which shows the long-term value of the wealth building potential from real estate. Now, middle of the graph shows sort of fairly neutral prices, neither rising nor declining. And this is somewhat unique to Madison compared to the rest of the country. You look at prices in Milwaukee, it was declining, foreclosure crisis. In Chicago, foreclosure crisis. Many parts of the country experienced large foreclosure crisis and prices were declining. Yet in Madison, it was fairly neutral in the process. And then once the economy, we cleared off the foreclosures and the economy began to create jobs, further price gain along with the COVID real estate boom. This is directly off the website. So very good job in terms of providing information to the members. So this is as of November, the sales in Dane County, there are data for other county, but since this is the biggest one, the sales were down 13.9% from 1 year before. And this is actually doing much better. Rest of the country, we are seeing down of 30%, 35%. So for Dane County to decline only by 13%, this is a very mild decline in unit sales. In the meantime, prices were up 10%. So you may even actually say that your business dollar volume, if you are a large brokerage, really did not change all that much throughout last year because decline in sales were compensated by rising prices, and hence the business revenue would have been roughly a small change in the business revenue. But because now that buyers have disappeared from the marketplace, even though home prices are still essentially touching the record high levels, there needs to be some price discount. And price discount depends upon days on the market. Let me take one sip of water just to clear up my throat, just excuse me. So our common sense would say longer the days on the market, larger the price discount, and it shows. So if you list a home to get a contract signing, maybe the home sellers sort of know there will be some degree of price negotiation. So if there's contract signing within the first week, it's about 5% price discount. If you're still getting a full price, congratulations, you are doing well. But on average, it's about 5% price discount. But as the days on the market lengthens, then there's more discount, such that by 3 months, 4 months, you need to do 10%, 15% discount in order to find buyers. So if you misprice the home from the get-go, expect to stay on the market for a long period. And again, the buyers are not there. Sales transactions are down. Of course, Madison is doing better compared to the rest of the country, but sales nonetheless are down, meaning there are fewer buyers in the marketplace and some price adjustments are happening. Given that there is some reduction from the list price, some people are saying, is home price crash inevitable? I mean, home sales have certainly come down. And also, people have fresh memory of what happened in 2008, 2009, when many parts of the country did experience about 30% price decline. Madison did not, but other parts of the country had that 30% price decline. And you see it on the national news. One of the value that you provide to your members, your clients, is to explain why national numbers that people read does not truly reflect what happens in Madison. So something you can always distinguish. But nonetheless, your client may be reading the national news and they are saying, look, I constantly hear about home price crashes impending. It's gonna come along. Maybe this is the year. Maybe we should hold back, wait for the prices to decline, and then I will get into the market. Or maybe your homeowners are concerned, oh no, I will lose some of the wealth that I accumulated in my housing. So rather than trying to predict what's going to happen to the home prices, let's just look at the factual information. So last housing cycle, so I'm looking at 2008 through 2012 period, there was a net job losses across the country. Recession, 8 million job losses. Today, you see that technology companies are laying off people, Wall Street's are laying off people, certainly mortgage brokerage, mortgage industry has laid off a lot of people in the mortgage industry. But at the same time, there's job creation. So you are adding jobs. So on net, there's no net job cuts. So certain industry is losing, other industry is gaining. So this time around, we are not seeing job cuts, or at least not yet. Do you look at the total number of people with jobs, W-2 statement salary jobs, so they're steady income. Many of you are on commission income, so your income fluctuates a lot. But people with steady income, we have 23 million more Americans currently with those steady income jobs. What about including independent contractors? Well, same situation, more jobs, 20 million more jobs now compared to back then. Subprime lending, widely prevalent, and it imploded. Those teaser interest rate, no income documentation, it blew up. Today, we have a commonsensical regulation, ability to repay before you get a mortgage. Show us the document, we're sure you don't overstretch your finances, and if so, then here's a mortgage for you. So we don't have those risky mortgages in the current environment. What about the 5 preceding years to the cycle related to home building? There was an oversupply back then. Builders built way too many homes. Today, we don't have that oversupply situation, much calmer building activity. Inventory of homes on the market, 4 million nationwide. Today is only 1 million, much lower inventory condition. Lack of supply means prices simply cannot have a deep crash. Mild crash, maybe, or even no crash, maybe, or even price gains possible, but definitely not a big crash given the lack of inventory. Mortgage delinquency at historically low levels, homes in foreclosure at historically low levels. So factual information and fundamentally different. So something you may want to quickly share with your clients to say, look, I know there's a lot of news out there about what may happen, but here are some factual information at least to keep in mind. So specifically related to the mortgage delinquencies, people who are missing payments for at least 3 months. So not a single month payment, but at least 3 months. You see this graph. So middle of the graph is the subprime loan implosion. Those bad mortgages blowing up. So delinquency reached 10%. Then you see the second little small hiccup. That was during the lockdown from COVID. People lost job or people were afraid what's going to happen to the next. So some people did not pay mortgage. But look what's happening today. It is at historically low levels regarding mortgage delinquency. So not the case of impending housing market doom or home price crash conditions. Inventory situation. I mentioned we are still short on supply. I know we are short on buyers, but we are also still short on supply. So lack of supply at least will provide support for home prices. Big price crash simply cannot happen if we lack the inventory. Here's an interesting graph related to the health of the homeowners. The blue line shows the home value, collateral value of all the homes across the country. So your home, maybe $400,000, neighbor's home, $500,000. You add up all these values across the country and it would be the blue line. It is a record high. The middle of the graph shows the price adjustment that occurred during the foreclosure crisis, of which Madison really did not go through, but nationwide it went through. The bottom graph, the orange line, is total mortgage debt outstanding. Mortgage debt is out in the marketplace. And what I want to illustrate here is that home prices are rising not because of excessive mortgages, as happened in the early part of the graph. You gave mortgages, a lot of borrowing, it pushed the home prices. This time, mortgage debts are barely changing. I mean, it is increasing, small amount, but you see the huge gap. That is implying home prices increase from fundamentals of supply and demand, not from this excessive mortgage lending that occurred. So again, fundamentally different this time compared to what many people are comparing to say, are we in for another home price crash? In the meantime, building activity is very restrained. This is a single family home construction. The middle blue line is the historical average. So some years builders build more, other years a little less. I guess change depends on interest rate environment. So it fluctuates. But note, prior to the recent years, it's been more than a decade, more than 10 years where the builders have been greatly underproducing. And that is why, in fact, even before the arrival of COVID, even before COVID, there was a housing shortage in Madison. There was a housing shortage across the country. We've been relaying this information to Congress to say there's a housing shortage. Let's make sure that we have adequate supply into the future to assure that builders are not hampered or somehow provide some tax credit incentives to build more housing. We had a housing shortage before COVID. It exacerbated during the real estate boom of COVID. Now it doesn't feel like a housing shortage because we have fewer buyers. But if somehow the buyers return, we will again face housing shortage because the builders really have not ramped up production. So it's going to take multiple years to really fill in this the deficit in housing production. Apartment building is a little different. Multifamily. Apartment building activity is actually right now at a 40-year high. So if you are a real estate investor, you have the single family rental, past couple of years, the rents have been good, but watch out because rent growth may slow down as new apartment buildings are filling the marketplace. So construction on the apartment buildings are very active, and all these empty units will come onto the market, and hence more competition, and the ability to raise rent would be more limited given the active apartment building construction. Apartment rent growth, this is again nationwide, all real estate is local, but many local markets essentially follows the trend. And the trend is that 2019 before COVID, rent growth of about 3%. The first year of COVID, job losses, so there was a rent concession, but then the rents really increased. But this year, expect much milder rent increases, in fact, smaller than consumer price inflation. We are really frustrated when we go to grocery store, daily reminder prices are rising, but the rents will be rising a little tamer than the overall consumer price inflation this year because of these increased supply coming onto the market. Now let me turn to the hopeful news that the worst in home sales, again, home prices are still holding on, but home sales have been falling. But the worst in home sales may soon be coming to an end. First is, let's look at the mortgage rates. Mortgage rates have actually fallen from the peak that occurred in November. Early November, mortgage rate was above 7%. Now, don't expect 3% or 4% mortgage rate in your lifetime, in my lifetime, from this time onwards. We already experienced that past 2 years. It will not return, in my view. Those were bonus rates. Congratulations if you have those low interest rates, but we will not return to those rates. 6% mortgage rate, we are very close to it already. 5.5% mortgage rate, I think, is a distinct possibility by spring home buying season. So this falling mortgage rate just means that some people who got priced out at 7% mortgage rate will reconsider at 6%. So the gate opens a bit, and the gate will open up even more if the mortgage rate was to decline to 5.5%, possibly by the late spring. And here's why I think mortgage rate could decline further. I put two graphs here. Red line is the 30-year fixed rate mortgage, average rate, your consumers. Blue line is what the US government is paying to borrow money. So there's a debt debate right now in Congress and a huge budget deficit. So government is borrowing money. And what's the interest rate they pay? Essentially the blue line, that's what they pay. So the government interest rate and the mortgage rate are moving very similarly. In fact, through democratic process, through NAR lobbying efforts, we said that middle-class Americans, hardworking middle-class Americans should be able to buy a middle-priced home. And way to encourage that is to say that mortgage rate will only be a little bit above the government borrowing rate. So this graph is essentially showing that. And how? Well, let's look at the Veterans Affairs mortgage, government guarantee, FHA, government guarantee, mortgage originated by Bank of America, Chase, or say Quicken Loan, eventually get packaged and get sold to Fannie and Freddie, government guarantee. Because of this government guarantee, which NAR advocated, mortgage rate that the consumers face to buy a home is fairly, just very similar to government borrowing rate. So you see the two lines move together. And of course, towards the end, you see the sharp rising mortgage rate, which is also coming from increase in government borrowing rate. But if you look at the graph a little more carefully, what you notice is the following. See the gap between the two lines? So I'm going to show you the gap between the two lines, or the spread. So this is the spread between the two lines. Average is the blue line. So sometimes it's a little bit above average, sometimes a little bit below, but not excessively large, except for very few occurrences. So you see in the middle of the graph in 2008, there was a huge wide spread, but then it quickly disappeared. Second occurrence, it happens during the COVID, early months of COVID, people did not know, so there was, but then it disappeared. Right now, we have this abnormally widespread. People are trying to analyze why that's the case, but history says that this widespread never lasts for a long time. After about 6 months, it disappears. So just in time for spring buying season, maybe this spread will go back to normal. And if that's the case, to put it simply, mortgage rate that your consumers would get would be around 5.5%. Hold 1 second. I'm going to check the financial news right now, what the government borrowing rate is. Hold 1 second. So government borrowing rate today, right now, is 3.4%, which means under the normal spread, mortgage rate could even be like 5.2% if we got back to the normal spread condition. Can you imagine your buyers, after having seen 7% mortgage rate, suddenly see 5.2% mortgage rate? So that is a distinct possibility in the upcoming months, and not a guarantee. I mean, right now, mortgage rate is still above 6%, but I think it will slide down under 6%. We'll take it, but still with the possibility of mortgage rate going down even under 5.5%, and that's going to be a big help in terms of getting some of the buyers back into the market. Survey by Fannie Mae. Very simple question. Is it a good time to buy? And Americans are saying, no, it is not a good time to buy. But look at the very last point. It's a slight uptick. And you say, well, that's no big deal, slight uptick. But at least it's, stopped bleeding. It's stopped bleeding, and people are at least showing a little better sentiment now than before. But the one other element is the following. Look at the middle of the graph at the elevator levels. See how the line is moving sideways, even at the elevated normal levels? This was during the time of real estate boom. So there was no clear indication that consumers wanted to buy, which you experience. So what consumers say and what consumers actually do not necessarily match up. So right now, consumers are saying maybe it's not a good time to buy, but if the mortgage rate decline and more inventory shows up, so more choices, maybe they will enter the market. So don't just think that what consumers say is actual reality. What consumers say and what consumers actually do not have to align as reflected in the middle of the graph. When the real estate boom, but consumer sentiment really did not change during that time period, so it was fairly neutral. But right now, this is the survey result. Mortgage applications. It's been bleeding downward throughout last year from rising mortgage rates. Before turning upward, you have to stop the bleeding, and at least it looks like its bleeding is stopping before you see an improvement. And in fact, this week, the data that came out just yesterday is showing a little uptick that you see on the very last data point. Maybe consumers are already stirring with interest about getting back to the market because they saw a little falling in mortgage rates. It could decline more. I mean, mortgage rate could decline more, which means more upturn in the mortgage application to buy a home. So at least it looks like we have stopped the bleeding. That needs to occur before an improvement. Let's hope that will be the case. Now, turning to the broader economy, this is a GDP number, and whether or not we want to call it a recession or not, is somewhat sluggish, at least the recent data. The early part of the data shows a big decline from the lockdown, then the big increase once the economy reopened, catch-up demand. But lately, it's been trending a little below negative or slightly above negative. It's been trending this way. I think Germany will go into a recession. Their energy costs, electricity bill is like triple, quadruple of what it was last year. Ukraine's GDP is down 35% or even 40% from the terrible situation they are experiencing out in Ukraine. But right now, American economy is just right along the zero line, moving slightly above or slightly below that condition. But good news is that the worst in consumer prices appear to be over. Consumer prices are still rising. I mean, you experience at the grocery store, but the gasoline prices are actually slightly lower now compared to 1 year ago. Price of clothes are beginning to show a little better condition. So maybe we will continue to see this deceleration in prices. I mean, it is still above 1 year ago, a little less increase than before. Now, some of your potential clients have been already compensated. Social Security check recipients, they receive 8% cost of living adjustment. So if the consumer prices come down while their paycheck has risen by 8%, that's something of an improvement in terms of their purchasing power. The job numbers are coming back as well. Nationwide, the early part of the graph shows what happened during COVID, then steady job recovery, and now we are back to record high in terms of jobs. I mentioned uniqueness of Madison. You did not really experience the foreclosure massive crisis, nor the price plunge 10, 12 years ago. However, there's something also less pleasant happening in Madison. So something good was happening in Madison, but something a little less pleasant, which is the following. This is looking at the job situation. How many people have jobs? Latest information versus right before COVID. So you can say right before COVID, it was record high jobs. So how do you compare to pre-COVID? And Wisconsin is showing minus 0.7%. That means there is about 1% fewer jobs in Wisconsin now compared to pre-COVID. But if you look at the southern states like Texas, they have 6% more job. Florida, they have 6% more job. So blue color states are showing more job now compared to pre-COVID, while the orange color is showing fewer jobs compared to pre-COVID. Similar condition in Minnesota, Michigan, but it's almost back, but you can see that Wisconsin is trailing behind rest of the country or many other states across the country. Here's the actual job numbers in Madison from year 2000 onwards. So from year 2000, steady job growth. In fact, right up to pre-COVID, you are looking at 80,000 job addition in 20 years. What's the stadium capacity for University of Wisconsin Stadium to watch a football game? I'm not sure what it is. Is it 80,000? Well, this is a stadium full of new people with job in the local area before COVID. Then COVID hit, which knocked away the jobs. Now you are trying to recover, but you have not fully recovered. Florida and Texas, they are well past their prior peak, but not in Wisconsin, not in Michigan. Some people are saying it's partly related to the policy of lockdown. If you had a longer lockdown or more stricter lockdown, it made it more difficult to recover from that. While the states that had a more quick rebound were the state that essentially said, okay, you can get back to business, you can go about with less strictness related to the lockdown. I don't know if that partly explains for it, but right now, Madison, which have been performing very well prior to COVID, is lagging behind the rest of the country in terms of job market performance. Office market. I put this office market just to illustrate that if you own a building, office building, be concerned. But I also want to relay in terms of people in Milwaukee, people in Chicago, they have not fully come back to office. They're working from home. I'm in Washington, D.C. Streets are still fairly empty because federal government still has a policy you can work from home, and many people are working from home. So if office vacancy rates are rising, it means that people are saying, look, I don't want to live so close to downtown areas. I want to live further out into the suburbs, exurbs, or even 1 or 2 hour drive away, which Madison could potentially benefit from this trend. So as the office market remain uncertain, it just means that it could benefit mid-sized market like Madison, where people even from Chicago begin to say, look, if I have to go to office only 1 week a month, I'm gonna have a home out in Madison and then drive through, go to Chicago just for the 1 week a month. So we don't know what the equilibrium regarding what the office policy will be. There will be many trial and error, but this rising vacancy rate, cities like Madison would be a beneficiary of this trend. Home sales forecast, to wrap it up, is that this is a quarterly forecast from 2019 pre-COVID. And then I showed you the two boxes. The first box, blue box, is last year. You see steady decline in home sales. The red box is this year's forecast. I think the worst is coming to an end because mortgage rates are falling and it has the capacity to decline even further. So that will begin to lift home sales. But if you look at the total box, which one is larger? Well, the blue color is still a little larger than the red box. So overall annual sales number, even though the worst is coming to an end, is the following. So go to the bottom 2023 forecast. I think the unit sales annual number will still be down about 7%, while home prices will be fairly neutral. Midwest will actually do better than the coastal markets. Coastal markets, I think there will be some price declines. Big decline in San Francisco. I think maybe even 10%, 15% price decline in San Francisco because office vacancy rates are skyrocketing in San Francisco. Technology sector slump, and also people don't want to go to downtown San Francisco, either whether it's dirty, high crime, people are not interested in going to downtown San Francisco. So San Francisco, I think we'll see about 10%, 15% price declines. But the Midwest market, whether Indianapolis, Milwaukee, Madison, there may be a slight price increase because national price change, I'm essentially saying, is zero. Some markets with slight negative, other markets slight positive. But 2024 should be a steady improvement year. I think all that unnecessary widespread in government borrowing rate and mortgage rate will completely disappear by then. And also the economy should be in much better position. So this is showing that 2019, before COVID, uninteresting. 2020 and 2021, double-digit revenue growth. Last year was a transition. This year, even though the worst may be coming to an end, it will still be down on an annual basis on the business revenue. Not home prices, but on business revenue. But next year, anticipate again another double-digit percentage gain. So thank you very much for giving me some time to share some thoughts with you all. So thank you very much.
Thank you, Dr. Yoon. We're going to open it up for a couple of questions. I'm going to let Monique take our charge over in the Education Center.
You will need to unmute in the Education Center, just a heads up.
Any insight on inventory?
So the inventory level right now is above 1 year ago, as you know. In some markets, it's triple of what it was just 1 year ago. But if you compare the number compared to 2019, it is still down. So what it's implying is that we had an extreme inventory shortage, and now that extreme inventory shortage is no longer there, so it's rising. But most interesting data is new listings. New fresh listings are lower now compared to what it was 1 year ago. So people talk about, that could be an oversupply. Well, new listings are not popping out because homeowners are loving their 3% mortgage rates, which is the reason why we need to assure that a way to alleviate housing shortage is to build more housing units, build more single family units. It is not for the first-time buyers. It is not for the millennials. It is for the trade-up buyers. But that trade-up buyers, once they buy, it releases their old home onto the market for the first-time buyers. So we need to assure that adequate supply comes to the market. But right now, we don't have sufficient supply, even though overall inventory level right now is a little above 1 year ago.
Anybody else? See any relief for the builders in the future, relief for the regulatory hurdles that they're going through?
I believe the question may need to be repeated. It was not clear on our speaker.
I'm sorry.
Lawrence, do you see any relief for the builders from a regulatory perspective?
You know, the home builders, they were very cautious last year. In fact, there was a little panic for the simple fact that, you know, building activity, buying process is a long process. People see a land and say, and somebody said, okay, build me a home, I want to buy it. But they initiated the process when the mortgage rate was 3%. Then once after, you know, 9 months when the home was completed, person said, no, I cannot buy, mortgage rate is too high. So there was a large increase in cancellations. Builders were panicking what to do. But then builders realized once home is completed, they can find a buyer. So the days on the market for actual completed building, I know there are some, you know, incentives, discounts, but they're still able to buy. And the public, at least the public builders, they're making profit, even with a price discount, implying that there's a profit incentive to keep building. And I hope the builders follow those incentives.
I want to thank Dr. Yoon for joining us today and your very insightful presentation. And we look forward to future time with you in the future. So thank you for your time today. And we're going to take a short break and we'll be back in about 5 minutes. Thank you.
Thank you.